Hi, welcome to Market Call. I'm Lindsay Biscaya. Rebecca Teltscher is on the show today. She's a portfolio manager at Newhaven Asset Management, and she will be taking your questions on Canadian stocks. And you can call us toll free if you have a question, 1-855-326-6266. You can also email us at marketcall@bnnbloomberg.ca. Great to have you. Thanks for coming in.
Thanks, and welcome to BNN.
Thank you. Okay, so we're into September now. Often that's considered a bit more of a volatile month. How are you feeling right now, especially with everything going on in the States with the Federal Reserve? Are you feeling cautious heading into this month?
Yeah, I mean, we're cautious on a good day, let alone where we are today. We are conservative investors. We like to focus on dividends in general. And our thesis is really just, the more you rely on dividends coming in, the less you're relying on the overall market to do most of the work when you're looking at total return. So where we are today in the market, it's interesting. I feel like the market's doing one thing. The economy is telling a different story. But then if you also look at subsectors, gold is telling a different story and bonds are telling a different story. So, I think there's a lot of hesitancy. You look at, gold as a safe haven, and we've seen gold prices really increase in the past 2 years, but really also in the past 3 months. And then you see the economic data coming out, which is, hit or miss, a little bit murky, a little bit cloudy. The impacts of tariffs haven't really fully priced in. And then you see long bonds, like bond prices are selling off. And so they're all telling one story, and then the markets keep reaching all new highs. And so, it's a bit of a head scratcher. I mean, we have our ideas as to why the market's reacting, but, there really seems to be this risk on sentiment, and that makes us extra cautious today.
And you expect it to get even more volatile in the second half of this year?
Yeah, I mean, everyone's talking about September being a volatile month historically. Sure, like that can play a part of it. But really, I'm just looking at that disconnect between the market and the economy. And that disconnect keeps getting bigger and bigger. So yes, we are in a policy-driven world right now. So everything is going to fall onto what the Feds are going to do in a few weeks. But besides that, I'm just, it's interesting because we're in a bad news is good news scenario. So I think right now, I think there's a jobs report coming out in the U.S. this Friday, and I think people want to see bad jobs numbers because bad jobs numbers will equate a for sure rate cut, in September. But we're looking at it like, well, the economy is showing signs of weakness. A bad jobs number means that there are problems with the economy, that we are not at all-time highs for employment, that jobs are rolling over, that, maybe consumer sentiment is going to start rolling off. Like, there's trickling effects. GDP numbers are coming down. There's Canada, I would believe, is already in a recession, based on just the data that we're seeing. So I think now is time to be cautious. That doesn't mean be out of the market. It just means being careful at which areas of the market we focus on.
So what would that be then? If we're looking at certain sectors, like I know you say you like to be a little more conservative all the time, are there certain sectors that maybe are a little more immune to what's happening or what could happen?
Yeah, so, I look at, let's just say the S&P 500, you think you're getting a basket of 500 stocks, and while that is technically accurate, the exposure you're getting is actually very much skewed to technology. I believe technology, or the Magnificent Seven, just those 7 stocks alone are over 30% of the S&P 500. NVIDIA, one stock alone is 8% of the S&P 500, would probably be even more of the NASDAQ just because it is more tech heavy. The same thing with the TSX, although different concentrations in different sectors. So the TSX, for example, has had a 5% move last month alone, but that's because 11% of the TSX is just gold stocks. Right. So again, you look at owning, the benchmark or the entire market, but you're actually getting a lot more concentration risk. So, the sectors that we focus on are a little bit more boring, a little bit more conservative, more mature in their life cycle. Our largest weightings are utilities. We like pipelines, telcos. We do like banks, although we don't think right now is the right time to be buying banks given this economy. But we really like to focus on critical infrastructure that cannot easily be replaced, and infrastructure that's not necessarily going to change with regards to where we are in the market cycle. I think of a utility, and people are not going to stop using their fridge or turn their lights on just because we're in a recession. Where they may cut spending is on discretionary items, but they're most likely not going to cut their electricity. And then the overarching thesis is also just increasing electricity demand. And so regardless of where we are, that electricity consumption is going to grow as technology continues to increase.
Okay, we're going to take a quick break before we head to the phone lines. Thanks so much for that. We'll be back with Rebecca Teltscher in just a moment. Stay with us. Welcome back. We are going to go right to the phone lines now. John calling in from London. Hi, John. What's your question?
Hi, Lindsay. Hello, Rebecca.
Hi.
My question's on Whitecap Resources. I bought it in June of 2020, courtesy Eric Nuttall. It was a top pick. Did really well. Started paying a dividend, increased the dividend, pays it monthly. Love that. It's carbon neutral, and it just merged with Varen. And I'm waiting for that Varen revenue to hit the income statement. Is it a hold for me at this point? It's done really well, or is it an ad? Thanks very much.
Okay, what do you think?
Yeah, it's a good question. So we don't own Whitecap. It's funny, every time I come on Market Call, I always get a Whitecap question. I should, again, it's a name that we follow. We don't own it, so I'm not as familiar with it as I would be with some of the holdings that we do own. And I'll talk about like our favorite oil name in a second. But Whitecap, so it merged with Varen, which is the old Crescent Point. So we're talking about light oil with a high decline rate. Now their decline rate is lower than low for the sector, but we're still talking about a higher decline rate versus other types of oil. They've done a really good job with their enhanced oil recovery, so trying to mitigate those decline rates and doing everything they can to increase their productivity. So I think we're dealing with a good management team, focused in Montney and the Duvernay. So they are expecting about $200 million in synergies from the merger, and it should be accretive to Whitecap over time. I think if you owned the Varen stock, like the Varen was a better price, like part of the deal. Like if you own Varen, that was the better end of the deal versus Whitecap. I think for Whitecap, a little bit more patience is advised. So if you own it, I would probably continue to own it right now. In terms of adding more to it, I think at these prices, I would definitely own Canadian Natural Resources, or CNQ. That's the name that we like in that space. We're dealing with premium assets, lower decline rate, a nice mix of oil and gas, and you're really talking about a premium management team. If you want to talk, you mentioned about the dividends. So dividends for Whitecap is safe at these levels, but what we've seen with CNQ is that dividend is most likely, and I don't want to say never is never, but they didn't even cut in 2020. They didn't cut in 2015 or 16 when OPEC collapsed. So they have never cut throughout their entire history. So if you're looking at a company that it gives free cash flow back in the form of share buybacks, consistent dividend increases, and they're going to soon reach that 100% free cash flow where they give that back all back to their shareholders, I think that's the premium name that you want to own. And at these levels, I think it would be a buy right now. So if you're looking to add to your position, we would probably look at maybe holding Whitecap and then adding to CNQ.
Okay, so it is a hold Whitecap then. Let's move on to Terry. He's calling in from Edmonton. Hi, Terry.
Good day. I own this Emera. I'm up 40%. I want to sell it and get into a stock that's down a bit. So I'll look at your top picks and maybe I'll choose one of them. Thanks a lot.
Okay, we're looking at the Emera chart right now. You like this one?
I do like Emera. I'm, hesitant to sell any of my utilities. I love them so much. But you're right, in terms of the stock price, we have seen pretty good appreciation. I mean, it's up 21% year to date. It's done really well, but it's also because Emera was really getting no love in the past few years. I think I recommended it as one of my top picks, but like back when the dividend yield was over 7%, now it's about 4.5%. So, it's done extremely well, but I have trouble trimming a name that has been really good to us, and that's doing what they say they're going to do. They operate in very positive jurisdictions. Their largest jurisdiction is Florida. That's a really good regulator for utilities. They're able to recoup some of their storm costs from like the hurricanes that they had last year in Tampa. And actually I think it was yesterday that they just came out with news. So Nova Scotia Power, there was a rate freeze there for a few years, and now they're coming out, and it took, I think, 6 months of negotiations, but they're about to apply for a rate case in Nova Scotia. So we should see an increase to those earnings, maybe not in 2025, but starting in 2026. So positive news with regards to inside the name of Emera itself. And they've also done a good job with their asset sales. They sold New Mexico Gas. They sold a portion of the Maritime Link. So their debt levels are okay. Their dividends okay. They should be able to increase it at a lower level than historically, but they'll be able to continue to increasing that dividend. And then I look at the sector in general. Like I mentioned, utilities is our favorite sector right now. If we see the market rolling over, which is what we saw in April, we're going to see some money coming out of those high torque sectors like technology in Canada. We're going to see money coming out of Shopify, and we're going to see some of those names go into those more defensive sectors like utilities that are, let's just say, bond-like returns. And so we look at it as like dividend plus capital appreciation. So you have some of that yield, some of that capital appreciation. So, I mean, I probably wouldn't trim it, but we're long-term investors as well.
Okay, one last caller before we go to break. This one, Chris, calling in from Victoria. Hi, Chris. What's your question?
Oh, hi, Lindsay. Hi, Rebecca. Thank you for taking my call. Rebecca, I'll keep it short because I want to leave it to you to respond on Premium Brand Holdings. I bought it on your recommendation. I'd like to buy more, and so I would just love your outlook on the company. Thank you, and have a great rest of your week.
I mean, it's done well throughout the summer, that's for sure.
Yeah, so I mean, I appreciate that you bought some on my recommendation. It was actually pretty scary because I think I recommended it around $80, and then it was, because that was the newest stock we bought for our clients, and it was back in January at around $80. And then what happened was the whole tariff situation. And funny enough, Premium Brands does have a lot of cross-border. So it has operations in Canada and the US, but very limited cross-border. And I don't think the market understood that. So I think the stock dropped to about $74 during April. And so for a while we were underwater, but I was so convinced on that stock. We did research for over a year, talked to management 3 times before making an investment decision. One of the strongest management teams in that retail space. They're very conservative. And so here's the thing. They're at the stage where they are about to do a large build out in the US. They didn't have the capacity to do so. So over the past few years, they've spent millions of dollars. So I think they're almost done, $750 million of capacity expansions in the US. Now they're ready to take US orders. So they have their existing relationships, let's just say with Costco in Canada, and Costco in the US is saying, great, can you bring these products into the US? The problem is going national in Costco USA is, 10 times the size of going national for Costco in Canada. So they needed to build capacity. That capacity is pretty much built. So think of a pipeline. They already made the investment. The pipes are in the ground, and now they're just waiting for the orders to come in. So in my opinion, I think the stock is going even higher. I think at its top back many years ago, it reached 120. I think we could see that again. Obviously, I'd rather buy it back at $74. It's now it's now over 90. But what I think is happening is we're starting to see interest. Like RBC had it as a hold for many years, and they now just upgraded it to a buy last month. And I'm thinking, great, RBC is finally seeing what we've been seeing for the past few months. It's one of the benefits of having a really long-term time horizon, because I saw this capacity expansion coming through. So I'm like, okay, it's just a matter of time before those orders kick in. They haven't yet. So I think as we can start to see these new US sales coming through their earnings, that stock price is just going to go higher.
Okay. All right. Well, take a quick break now. We'll be back with Rebecca Teltscher just after this. Stay with us. Welcome back. We're going to start with an email from Rebecca now. Rebecca writes, could I please get your opinion on Celestica, and would you buy it here? So Celestica Electronics Manufacturing Services. What do you think? Look at that chart. Would you buy it right now?
No. I mean, so first, it was never on our list to start with in terms of, Celestica, I mean, it did extremely well. Look at that chart. It did extremely well last year. It's up 100% year to date. So yeah, but the problem is it's linked to AI. And so, I mean, anyone who listens to me, I've been wrong so far, but I don't think I'm going to be wrong over the long term. But I think this is, I don't want to call it a bubble, but it is overvalued. So anything that's linked to AI, so Celestica, they over 50% of their revenues coming from hyperscalers. So they are doing really well based on these big data center build out. But I think the stock has really gotten ahead of itself. I don't know what its PE ratio is, but I would imagine it's above 50 times earnings. But for us, it has been a good stock, but it's just too risky of an investment for us and too risky of a sector for us right now. There's also no dividend yield, which obviously we don't like as well.
Okay, let's move on to Daniel calling in from Markham. Hi, Daniel. What's your question?
Hi, Lindsay. Hi, Rebecca. Great new host and great guest as usual.
Thank you.
And my question is on Exchange Income Corp. What entry price do you see opportunity to buy the stock after it's run up? Thank you for taking my call.
That's a good question. What do you think?
Good question. Oh, I'm so sad about this one. It was on our list last year to buy, and I feel like we missed the boat. Maybe we didn't. Maybe it keeps going from here. But we were looking at it when it had a dividend yield of 5.5%. Now it's 3.7%. I want to wait for a better entry point, but I do like the underlying business. So, their dividend is still growing, and they have an aviation sector, which, aviation you could think is very cyclical and if we are going into a weakening economy, that's maybe not good. But, a lot of their businesses are in northern Canada or rural areas where they're often operating as a monopoly in the areas that they work in. They have a lot of good relationships with Aboriginals, so they don't have the pilot shortage that we are seeing in some of the other airline industries. So again, they own a lot of different manufacturing businesses, but they're often the monopoly in where they operate, like in terms of pressure washers and windows and things like that. The CEO is fantastic. The reason we probably didn't get in a year ago was just that we felt like it was the CEO that is basically sourcing a lot of these acquisitions, and he's the brainpower. So we were just kind of concerned about continuity, what happens when he retires. And so we took our time, and I don't want to say we missed the boat, but we didn't get in at this point. And so it's on our watch list, but we're probably not buying it at $70 right now. I'd want to see it get back into at least the 60s before we look at it again.
Okay, so you like it, but probably not a buy right now. Okay, we're going to move on now to Sean calling in from Swift Current, Saskatchewan. Hi, Sean.
Good morning, ladies. I'm getting closer to retirement, so I'm transitioning out of my small and mid caps into larger dividends, but I would like to own some REIT. What do you think is the best REIT to buy right now?
Okay, so real estate investment trusts. What do you think?
Yeah, I don't have a favorite REIT right now. And the thing when you talk about REIT is there's so many different subsectors. So there is, retail REITs. Again, I'm not a fan of retail REITs just because I'm not a fan of I'm nervous about the consumer and the economy right now. So probably not the best time to look at a retail REIT. There's office REITs, which we really liked Allied Properties. We like the management team there. But again, the fundamentals are not looking so great. So that would probably be the one that we looked at the most serious. But their vacancy numbers are a little bit worrisome, like their occupancy rate. They have pretty hefty expectations for the second half of this year. So I'm not sure if they'll be able to exceed it or not. They haven't cut the dividend, whereas other office REITs have, but we do like the jurisdictions that they operate in. They have a very interesting core assets that are really nice historical buildings. So we think we like the buildings that they own. Probably the sector I would like the best would be like the Chartwells, so like the senior housing. If we were going to do that, again, that was one we looked at. We didn't invest in it at the time. There are risks when it comes to senior housing. I mean, we saw that, liability issues during the pandemics. It's done really well. They said they were going to bring their occupancy up to 95%. They got there or pretty close to it. So that's probably the one that we like the best in terms of the demographics are in our favor, aging demographics. I mean, people are going to move to a retirement home on a needs basis, not on a wants basis. Yeah. So you can't really control those, that rate. We do own, a stock Severia that plays on to that aging at home demographic or deals with the aging demographic in a different way, aging at home versus going into a retirement home. But if I had to pick one, it would probably be Chartwell. Allied Properties would be one I would take a look at once we get to, let's just say, trough occupancies and see what happens with rates on the office space.
Okay, some good options there. We're going to move on now to Glenn, who's calling in from Collingwood. Hi, Glenn. What's your question?
Good afternoon, ladies. Aecon has had got way over its skis, had a big fall back. It's recovered a little. I'd like to know what your current opinion is, and maybe you could compare it to another one of your favorites, ALA, AltaGas. That's Thanks for your comments. Bye.
Okay, Aecon Group, what do you think?
Yeah, I mean, could both be an option? Could we buy both Aecon and AltaGas for two completely different reasons? So, okay, Aecon, I would probably say is one of the torquiest names that we own. So we own a smaller position of it, and it is cyclical with the economy. So it's a smaller cap name, and it's cyclical with the economy. It's a construction company. So we've seen a little bit more volatility in the name. What we saw in 2022, 2023 when the stock came off was regarding to there were legacy projects that happened during the pandemic. They were fixed price contracts. Obviously, the pandemic happened, so there was delays. Costs went up. Cost of labor went up. Delays with regards to the construction, and so there were a lot of losses. So one of them was the Coastal GasLink, the Eglinton LRT. So lots of issues there. I would like to think they've learned from those mistakes because they've told us numerous times they're not going to take large-scale fixed-price contracts going forward. But we are dealing with Aecon record backlog. A lot of it is public sector, so a little bit more stable than private sector projects. A lot of it is linked to utilities, so utility poles, utility infrastructure, and they have a large, almost not a monopoly, but they basically touch almost every nuclear project in Canada. So if we're looking, a lot of jurisdictions, Ontario, other places are now looking at nuclear as the option for baseload energy in the future, and Aecon is going to be part of that construction for almost every project going forward. So we like the mix. They also, even when things were looking really bad in 2020, they never cut the dividend. So you're getting, relative, let's just say, to an Atkins Realis that has less than 1% yield, you're getting similar exposure to the nuclear space, but you're getting almost a 4% yield. Stock's down about 20% or 25% year to date, but it probably was a little bit too high last year. So anyway, I'm buying it at these points, I think, with a record backlog and getting paid to wait, but I also think that stock's going to go higher from here. And then, do we have time so I could touch on AltaGas?
Yeah, just for quickly, let's touch on the other one.
Okay, so AltaGas, again, this is, we have a larger position in this name because it's a little bit more stable. So half of it is, gas infrastructure, and half of it is utilities. So they're the guys that are powering the White House in Washington, D.C. So that business, continues to grow. Again, we're talking about jurisdictions in the U.S. that have positive regulatory bodies, and then they're working on some natural gas, like propane export facilities off the coast of BC. And again, anything that, exports gas off the coast of BC to Asian markets and egress to Canada, I think is positive. So we're looking at a lot more stable growth. And so even though the stock has done better than Aecon this year, I just think AltaGas is a name you probably want to own forever. And again, 3% dividend yield, that's increasing. That dividend is safe, good management team. So we own both.
You own both. Okay, so we're going to take a quick break now, and when we come back, we will look at Rebecca's past picks. Stay with us. Welcome back. We are going to jump right into Rebecca's past picks, starting with Brookfield Renewable Partners. When you picked this, it was at $33.65, now up to $34.29, return of 2%, total return 8%. It does have a really good dividend, like 5.9%. You holding this one?
We are continuing to hold it. And it's funny, the stock price isn't really doing much, but the company itself is doing a lot. I mean, when I recommended it, they had announced the huge deal with Microsoft where they're going to be producing 10 gigawatts of power, renewable power, wind and solar over the next 5 years. Since then, they've made more announcements, like they're going to, they made a deal with Google to be purchasing some power from them. And I don't think it's going to be the last. This is there's a lot of tech companies that need reliable power for their data centers, for all their AI generation that consumes a lot of electricity. And so I wouldn't be, and these tech companies also want, emissionless, like carbon-free power. So they're going to look for a renewable company like Brookfield Renewables. We like their hydro assets that are long life assets. And they also have exposure through their Westinghouse acquisition with Cameco to nuclear. And we kind of talked a little bit about nuclear with Aecon, but they do, the servicing and the servicing for a lot of nuclear reactors. And so we like that business has been doing really well for them too. Growing their dividend over 5% yield. And I think, it came off a little bit because there were issues with U.S. growth with that big, beautiful bill in the United United States and how long those tax credits for renewables were going to last. But what I will say is a lot of the U.S. renewables came off, but Brookfield Renewables, and owned by, Brookfield Corp, has such a large array of jurisdictions, and they have assets all over the world. So they just have a lot of flexibility. Okay, so if they can't grow in, the United States through 2029, they're just going to look at different jurisdictions. So I'm not worried about their growth going forward. They're going to easily be able to pivot more than other renewable companies.
Okay, next up, speaking of renewable companies, TC Energy. This is another one you picked back in September 5th, 2024. So at the time, as at $63, now $71, a return of 24%, total return of 30%. You still have this one? You still like this one?
Still like this one. A little bit more expensive. I'm probably not adding to it so much for new clients. But again, it's one of those ones that you're going to want to own forever. They have one of the best natural gas infrastructures in North America. So not just Canada, but through their Columbia acquisition, they have a lot of natural gas infrastructure in the United States as well as Mexico. What I like about them is, if I think about TC Energy or TransCanada 10 years ago, they had a lot of really big projects that had a lot of key project risks with regulatory risks. So what was it called? Keystone XL, Energy East, and Coastal GasLink that finally just got built. But now a lot of their growth are just smaller projects, brownfield projects, little jurisdiction risk, a lot more smaller expansions. So those are more likely to go through, minimal regulatory issues. And so they're just going to continue to grow, do what they're doing, and expand natural gas infrastructure across North America. So again, we like the name and we're happy to own it.
Okay, we have to be a little quicker with this last one, but TELUS, this one, when you picked it, was $22.71, down a couple of cents now. Total return, though, is 7%. TELUS had some big news yesterday, of course, too, saying it's going to buy back its shares of TELUS Digital. What do you think of this one now? Yeah,
it's funny. So when I chose a year ago, I was nervous about the economy going forward, which I still am, and the markets continue to go up. So I chose TELUS because it yielded 8%, and I actually thought, the stock market's going to go down. So I'm happy to collect 8% if stock prices are going to go down. That hasn't happened, but that's one of the same reasons that I'm owning TELUS today. It's a 7.4% yield, and it's a slower growth name, but again, very defensive industry. It's the pricing environment is getting less competitive with its peers. It's in a better financial position than its peers, so we're happy to own it and collect the dividend. And if there is some small capital appreciation along the way, great. But you're getting 7.5 to wait.
Yeah, okay. We're going to be back in just a moment with Rebecca Teltscher to talk more about Canadian stocks. That's just in a moment. Stay with us. Welcome back. We are going to go right back to the phone lines. John calling in from Burlington. Hi, John.
Good afternoon. Thank you for taking my call. A while ago, I purchased shares in ARC Resources and Tourmaline. I feel I'm a little bit overexposed to this sector, and I would like to reduce my exposure, but I'm not sure what the best strategy will be. Should I sell completely one of them, or should I keep part of my shares in both? Thank you.
Okay, ARC Resources down a little bit. What do you think?
Yeah, so natural gas prices are down. We're looking at temperatures that's starting to moderate. We're looking at a little bit of overproduction in the United States. In Canada in particular, what's not helping is LNG Canada, which is the export facility to bring natural gas off the coast to Asian markets. That ramp up has been a little bit slower than expected, but should be picking up. So, is right now that, I'm actually buying more ARC Resources for our clients, not trimming it. But again, it, really depends on your exposure. So we like both names, but we don't own both names. We own ARC. We prefer, if we were going to own two names, we would own, ARC Resources and Tourmaline, but in our pecking order, we choose ARC, mostly because ARC has embedded growth inside the name. They have a lot of inventory through their reserves, so they don't need to acquire to fund their growth, whereas Tourmaline does. And so we just saw Tourmaline do an acquisition. Funny enough, ARC just bought some assets from Strathcona. They didn't need to for their growth, but they did, and they have the capacity. We like ARC Resources because we think a lot of their gas prices are hedged to international markets, which have a higher price than Canadian natural gas prices. If you're going to trim, we'd probably trim Tourmaline, but I mean, if you have the patience, I would maybe hold on to it a little bit from here. We are getting to colder months ahead. We should maybe see, some increase in natural gas prices.
Maybe trim, but not sell outright, as John said.
Oh no, we wouldn't sell it outright.
Okay.
Like, I mean, ARC is a name we really like.
Okay. Moving on now to Beth. She's calling in from Toronto. Hi, Beth. What's your question?
Thank you for taking my call. My question is on CNQ, Canadian Natural Resources. I bought it at about 48, so I'm at a loss of about 10% right now. I was wondering, and it has a good dividend, but I'm wondering if I should still hold it or maybe sell it. Thank you.
Okay, thank you. Dividend 5.4% right now, so yeah, pretty good. But what do you think?
I would definitely not sell it. If anything, if you can, if you have extra funds, or if you have a lower exposure, I would add more to it at like $43. Around the low 40s. I'm happy to buy it. 5.5% dividend yield for the most, like the premium oil producer in Canada. I don't want to say it's unheard of, but it's a very good yield for a company as well disciplined with such strong assets, such a strong management team. I always say that CNQ doesn't just have the best management team in terms of the oil space, but I would say it's one of the best managed teams in the world. I mean, they don't have a CEO, it's like a management committee, but they are so well disciplined. And we've owned it through, the 2008, the 2015 crisis, the 2020 when oil prices went negative briefly. Mm-hmm. And we've seen their discipline, and they, just focus on the long term. They do always what's best for shareholders. They are always going to continue to raise that dividend, pay that dividend. They will buy back shares. They will pay it back to shareholders in every which way they can. Employees that work there are generally happy to work there. So they've kind of underperformed since the threat of tariffs relative to some of the torquier names. But again, we think this is a very good valuation to get the premium name and to own it forever.
Okay, so message for Beth then is don't worry about that, right? Hold on to it.
Buy more.
Buy more. Okay, so Stanley now calling in from Ottawa. Hi, Stanley. What's your question?
Hi. Thank you for taking my call. I value your opinion. I've been watching this show for at least a couple of decades, and you're one of the best analysts I've seen.
Thank you.
You're really good.
I appreciate it.
You're extremely thorough in everything you explain, and I appreciate that. I'd like to know your opinion of Shopify. Now, I personally believe the NASDAQ is at an extreme valuation, which I think might hit all the tech stocks sooner than later. But if you were to buy Shopify, what would be your entry price? Thank you.
Okay. Entry price right now sitting at $193. What do you think? What's the entry price?
I may not be one of your favorite analysts after I answer this question. I joke and I say Shopify is the NVIDIA of the North. Now, completely different industries. Shopify is an online platform, NVIDIA is chips. But in terms of everyone is flocking to that name. In Canada, there's very few, we don't have any, chip manufacturing, so there's very few technology names you can own. When we do get a technology name, it often gets run up. So for example, I don't know if I can't remember if now, especially because RBC had a big run last week, but at one point, Shopify was bigger than RBC in terms of market cap and one of the biggest. So it's definitely Shopify is in the top 5 of market caps of the TSX, probably about 6 to 7% of the entire TSX. That is huge for a startup technology company. It's not so much of a startup anymore. A few years ago, it wasn't making money. Now it is. But now the question is, does it deserve that premium valuation? Now, depends on who you're reading. Some people will say it's trading at 50 times earnings. Some people will say it's trading at 100 times forward earnings. Mm-hmm. Again, it depends on what your future views are. I believe, like you said, NASDAQ is at an all-time high. TSX is at an all-time high. this stock is reaching an all-time high, and it's very consumer-driven, right? So yes, Shopify has underlying growth, but it also is very consumer-driven with regards to that online transactional platform for retailers. I am concerned about about expectations for growth being way too high on this name. If I'm going to look at it, it would have to decrease by more than half. I don't think we would ever look at it, to be honest, because it's such a risky torque name, doesn't have that dividend yield for safety. It's a little bit too early in its growth cycle for us to own it. But I mean, I wouldn't look at it anywhere near its valuations today.
Interesting. All right. We will be back with Rebecca Teltscher of Newhaven Asset Management, taking your questions on Canadian stocks right after this. Here's how you can reach us. Welcome back. We're going to go back to the phone lines. Alessandro is calling in from Halifax. Hi, what's your question?
Hi, so thank you for taking my call. Hi, Lindsay and Rebecca. I'd just like to say I really enjoyed this call. I'm a first-time caller, and I'd like to thank all of you and everyone at Market Call for what you do.
Oh, thank you.
So, so my question is on Atkins Realis ATRL. I noticed that the PE is really low at like 6 times. And if you compare that to WSP at 45 and Stantec at around 39, that's really low. So my question there is there a typo somewhere here, or is this stock a screaming buy? So thank you very much, and have a great day.
All right. I mean, it is doing pretty well right now, specializing in engineering construction. What do you think?
I'm not sure where you're seeing that PE. It is definitely not trading. Did you say six to 7 times? It's not trading at that. It would be closer in line with WSP. It's possible that wherever you're looking at is either it's giving you the EV to EBITDA number, or there's a typo there, but it should be trading closer to WSP multiples, around 40 times earnings, because actually that's one of the reasons we don't own it. We like the exposure to nuclear, we like exposure to the public sector, but we don't like that it has a dividend yield of almost nothing, like less than 1%, and it has such a high valuation. So I think I mentioned it on an earlier caller, like we prefer with that same exposure to own Aecon that has a higher dividend yield and a more reasonable valuation versus an Atkins Realis that does trade at one of those engineering and construction premiums of about 40-something times earnings. The other thing I would say is Atkins Realis, they've done a good job recently, but they do have they are international. And so they do just carry more international risk. So, geopolitical risk and exposure, which kind of got them in trouble many years ago. But, new team now, new company. But, we're going to prefer an Aecon that's a little bit closer to home, mostly Canadian, a little bit of U.S. exposure, but mostly, Canadian exposure. Because for better or worse, we're familiar with at least the governments and the policies here.
Okay, moving on now. Gordon is calling in from Lethbridge, Alberta. Hi, Gordon.
Good morning, Lindsay and Rebecca. I believe in investing in companies which I pay into monthly. I've got both my auto and property insurance with Intact Financial. What are your prospects for this firm? And secondly, Rebecca, how many years do you think this bull market is going to run? I'm sure enjoying the ride. Thank you.
Enjoying the ride so far. What do you think?
I actually really like your thesis of, buying companies that you buy into. That's kind of why I own the telcos personally, because I hate them, but I also, usually like them as a stock, hate them as a consumer. But that's also how I bought my first stock as Dollarama, because I was shopping there a lot, and I realized this is a great business. So talking about Intact, I like the business. It's a nice diversifier in financials. The TSX is very financial heavy, very focused on banks, but this is a nice diversifier with property and casualty insurance. Again, there's always risks when it comes to weather events and things like that, but the company's done a really good job, strong management team. They have about 20% market share of the overall industry, which is pretty good. They are doing quite a bit of M&A. I think they've done 18 acquisitions, in the past 20-something years. They recently bought, the Jiffy app, which is interesting, a bit of a diversifier, the app to do home repairs and things like that. So you could see they are trying to diversify in the digital space and outside of insurance. We like the name. not so keen on the valuations right now. I do think it's something, if we see a broad market pullback, we would. So it's starting to come off now. It's actually starting to get interesting. Once that yield gets over 2%, I would be a little bit more interested in it. But for now, we're keeping our eye on. But I do think if we could get in, that would be a nice, solid long-term hold. With regards to how long this bull market will last, if you asked me last year, I would say it was, due to come. If you asked me the year before, I would say it's due to come. So I'm going to say it is due to come. But, how much longer we can live off of, government Fed stimulus, your guess is as good as mine, but the underlying economic details are basically showing that things are weakening and the consumer's kind of holding on for dear life. And I think that optimism in the market is kind of fueling into optimism in the consumer. But I think we're starting to see the figures get a little bit more cloudy and things, I'm hoping for a pullback right now because most of these stocks are trading at these valuations that to me are unsustainable. So it's very hard to put money to work right now. I'm actually hoping for a pullback.
Okay. Well, that's it for calls today, but don't go away because up next, Rebecca will share her top picks right after the break. Join us tomorrow on Market Calls. Stan Wong will be on the show. He's a portfolio manager at Scotia Wealth Management and will be taking your questions on North American large caps and ETFs. Okay, time now for top picks. Rebecca, you had Pembina Pipelines as one of your top picks for this time around. Good yield. You obviously like this one.
I feel like I choose it as a top pick every time I'm allowed to, because I can't choose previous top picks as my current top pick, but if I could, I would. Head scratcher as to why this hasn't moved along with the other, like TC Energy and Enbridge, probably because, those are the two big pipes, and that's where money flocks to when they're going into the sector. But Pembina should have that much flows of funds coming into the name, if not more. I mean, its strategic positioning in Canada in particular with regards to natural gas and oil infrastructure can't be compared. 80% of their cash flows are contracted or fee for service, and so that's what funds their dividend. That dividend is growing at about a 3% rate every year, but has over a 5% dividend yield. So it's like that best combination of, we think there's going to be quite a bit of capital appreciation, but you're also getting some good dividend yield plus some dividend growth. We think the underperformance is a little bit overdone right now. I think there was questions with regards to, they have this alliance pipeline that Enbridge sold to them, and there was recontracting that was done with a regulatory body getting involved in Canada, and so those rates have been recontracted for a 10-year lower. But I think analysts had factored in a much bigger negative financial impact than what actually happened. Going forward, they have so much growth. They're working on a Cedar LNG project. They have just so much growth ahead of them that I think over time that little impact on that alliance pipeline will be, minimal going forward. And we just think that their strategic positioning and their ability to collect fees at every phase of that cycle from where the molecule comes out of the ground to where it gets, shipped off to third-party sellers, they're able to collect and earn at every phase of that cycle. So we're happy to own it.
Okay, next one is CAE on the TSX. We talked about that kind of volatile market right now. CAE is down, but you like that.
Yeah, I mean, it's funny. This is actually one of two names that doesn't have a dividend yield, so we have to be pretty extra convicted on the stock price. It's had a good run, but they have two sectors, and both we think are going to work to our favor over the long term. So civil side, they do flight simulators for pilots. It's not a secret. There's a pilot shortage. They think they're going to have to hire 260,000 pilots globally over the next few years to meet pilot demand. All of those pilots are going to need training, and not just training at one time. It's continuous training as they train for upgrading on a bigger plane. So on the civil side, we think that'll do well. And then the defense side, that's the side that they've been suffering on. They acquired a defense company that had some legacy contracts that had low margins, but we saw Carney make an announcement that they're going to be increasing defense spending quite significantly in Canada. So, they're going to get to 2% of GDP, 5% overall goal. They're currently at 1.36. Q3. Huge spend on defense coming up, so any stocks that have exposure to defense should do well as well. So both sectors, I think, are working. Secular growth should outpace any short-term weakness on the economy.
Okay, and lastly, Northland Power. Looks like you like this one quite a bit as well.
Yep, recommended it a few times. Again, you're getting a 5.5% dividend yield to wait. Having that long-term focus has really helped. They had 3 large projects. One of them is actually complete, under budget, earlier this year, the Oneida battery storage. They have 2 other large-scale offshore wind projects. Hai Long in Taiwan reached first power, which is a huge milestone. So now they just have to copy and paste those turbines going forward. Baltic Energy, they're still installing their turbines right now. So those are both on time and on budget. The Northland Power has a great history of executing things. They leave a lot of buffers for their projects. So I think as these projects get closer to their completion date, that project's risk gets de-risked, and then the stock price goes up. I think we're starting to see it now in that stock price, but I still think it's early enough to get in before those cash flows come online in 2027. When those projects are all complete, their cash flows should increase by about 45%. So huge, and I just don't think that's being factored into the stock price today. Okay, so you're saying definitely buy this now. I think so. Even though it's had about a 20% run this year, I still think there's an opportunity to get in, because analysts, target prices are only for the next 12 months. But if you look beyond that, we're seeing a lot of growth ahead. Okay. Rebecca, thanks so much for coming in. Really appreciate your input. Thank you for having me. And thanks for watching Market Call. We will see you next time.